Now that the health care reform law is law, just how will the Affordable Care Act affect your taxes next year? And here to help us get a head start on the 2015 season is Brian Haile. He's Senior Vice President for Health Policy with Jackson Hewitt Tax Service. Mr. Haile, welcome. Good to see you. Before we get to some of the very sort of gnarly wrinkles in the Affordable Care Act, would you clarify a major change that has been in place for years and years and years, and that is that people were able to deduct health care expenses once they exceeded 7.5% of their adjusted gross income. Has that changed?
It has if you're under age 65. Going forward, you'll only be able to deduct those expenses if they exceed 10% of your adjusted gross income. However, if you're 65 or older, you still are subject to the old rules. You're able to deduct it if it's over 7.5% of your income, at least for the next 2 or 3 years.
So I guess you would want to, for lack of a better word, bunch those expenses into a year, so if you could, so that you would exceed that 10% threshold, right?
Exactly right. Although I think one of the things that we've got to keep in mind here, there's so many interesting tax-efficient vehicles to help pay for healthcare costs, including use of healthcare savings accounts and other things. So this has become a much more complicated area of the tax code, and it's hard to give good advice without knowing someone's specific conditions. But you're exactly right. Clustering those kinds of expenditures to the extent that you've got the cash to pay for them is always helpful from a tax perspective.
You raised it, so I asked the question, who can take advantage of those healthcare or health savings accounts?
You typically have to have a high deductible health plan, either that you buy in the individual market or that your employer offers. So if you have a high deductible health plan, and then you can set up a health savings account underneath that to help pay the cost sharing there, your deductibles typically, the co-insurance that you might incur, and your co-payments and the like. But it's really reserved for people who have those high deductible health plans.
And can that money, without bogging down here, can that money be carried over from one year to the next?
Absolutely. That's one of the great benefits of a health savings account or an HSA is that you can port it across years, and you can even port it across employers. So if you have a high deductible health plan and an HSA, you can maintain that HSA even if you leave that employer and change insurances. Not a problem at all.
One of the really tricky areas, Brian, it seems to me, with the Affordable Care Act are the tax subsidies that will flow to people who have incomes of, what is it, 400% or less of the federal poverty level, and how then you judge what your income is and what those subsidies are, and whether you're going to end up having to pay that money back if for some reason you go over that income threshold.
Well, that's exactly right. And let's put some concrete numbers to this. 400% of the federal poverty level for a household of 4 is equal to about $94,200. So we're talking about someone whose income is about twice the median household average. That's pretty good. And again, that's just for a household of 4. The way I would describe the health premium tax credits is really with 4 adjectives. Number 1, they're quite large. If you have a family of 5 that's making about $70,000 a year, well, that family can qualify for a credit about $5,600. That pays more than half of the premium for the individual insurance that they buy through the new marketplaces. It's quite a generous tax credit. The other part about the tax credit is that it's advance paid, so that the federal government will pay that credit to the insurance company all throughout the year so that the person doesn't have to put out the cash for the premium and reconcile at the end of the year. Quite the contrary, the federal government will help subsidize the premiums all throughout. But here's the funny thing about those new tax credits is they're very finicky. You only get the tax credits if you buy the health insurance that you have through the new marketplaces. It has to be a qualified health plan. So when we look at these new very large tax credits, we also have to take into account that they're pretty finicky. You mentioned, too, that you have to repay them if you misestimate your income, and that's exactly right, because the federal government's advance payments, those are based on your estimated income for the year. So if you estimate your income today and your income is higher or lower, well, when you settle up, when you file your taxes next year, you'll either get a larger refund back because the credit that you get is refundable, or you may have to pay some into the federal government because they may have overpaid in terms of your advance payments of the credit.
Oh, man, Brian, you explained that incredibly clearly, but my goodness, if you don't estimate right, you could really be stuck. Alas, we have to leave it there. I hope none of us are stuck in that predicament come a year from now. Brian Haile, Senior Vice President for Health Policy with Jackson Hewitt Tax Service.
Thank you, Tyler.
Thank you, Brian.